Paul, we definitely have some more requests off the Patreon line and off the chat line. And now, one-on-ones from two of our patrons are asking for Johnson & Johnson. Isn't this one of Warren Buffett's favorites? The Johnson & Johnson's very classic, safe stock.
I don't know if he's ever said that. I have no idea.
Oh, okay. I thought this.
You want to look at Johnson & Johnson right now?
Please do.
Okay. Johnson & Johnson. Everybody knows Johnson & Johnson. They make Band-Aids.
Hold on a second real quick. We have someone from the UK, Brat Bike, is saying you should do a video on all the stocks that have 8 pillars. You are in luck, because if you join the Patreon, tell them what they get, Paul.
The other day on the Patreon, I gave the list to everyone who's a Patreon of the 47 companies that have all 8 pillars checked. So what I did was I picked U.S. headquartered companies over $100 million in market cap. And there were 47. A large chunk of them were banks, which is a little misleading. But there were 47. I put the list in Patreon. That's what you got to pay for access for. $8 a month gives you the app and the website for free when it comes out. And you get access to me to be able to do these little nuggets here and there.
What you will get in the Patreon is Paul's full portfolio, what he's buying, selling, calls, and puts, as well as mine, which is not as exciting, Paul, but it is a portfolio of a general person who I have a pretty damn good saving for someone who's 39.
By the way, every show you say a different thing. I have no money. I'm rich as hell. It's like every single show.
Well, I mean, something to be proud of. Paul has educated me that the money I have saved will turn into a lot of money compounding over a bunch of years, and it brought me a lot of peace of mind, Paul. You know that. That's for exactly sure. So all right, Johnson & Johnson, baby, let's do it.
$400 billion company. This is a big company.
Wow.
PE ratio X. It's 24. Pass. Profit margin 17%. Check mark with a 67% gross margin.
Wow.
Dividend yield 2.7% on $4 billion. $400 billion, we'll call it $10 billion on the nose again. Just to make it even, it's a little over $10 billion. Let's just call it $10 billion. So we have an X and a check mark.
Let's do revenue growth over the past 5 years.
$70 billion to $82 billion. Check mark. There was a big jump right here. So something tells me on a company of this size, especially with how consistent their revenue was back here, that there was some sort of acquisition that happened here. And we can look at that in the cash flow statement if I remember. But it is a check mark there.
Profit growth over the past 5 years, Paul?
Yep. Let's go to profit growth. Ready? 15.4 to 15.1. X.
Uh-oh.
Now, one thing I do want to add in here to look at. Operating income. This is the income the company generates before taxes, before taxes and before other income and expenses. So it basically shows you and before debt payments. So how is the company itself, if it was free of taxes, free of debt, and didn't have any other extra expenses and profit, like, they might have made an investment in something that worked out. This is what I want to look at too to see the health of the company, how it's doing. 18 billion to 20 billion. So it's growing a little bit, but as you can see, it's only up 25% in the last 10 years. So Johnson & Johnson is a very slow growing company, folks. There's not much excitement there. So when we do our multiples, we want to have even at 20 PE and 20 free cash flow, that's too high. I don't think that's justifiable for a company that size.
How about pillar number 5, number of shares outstanding? We want this going down.
2.77 to 2.65, check mark.
Okay. How about current assets greater than current liabilities, which is pillar number 6?
What do you think this is going to be?
I think they're doing fine.
So 57.5 billion and 38.8 billion, check mark there.
Cha-ching. Okay, great.
And they almost have enough cash on hand to pay off 60% of their debt, 55% of their debt.
Free cash flow growth, Paul?
Okay, kids, free cash flow growth. Oh, wow, look at this number. This is good. Look at this, very low. It's about 20%, not even 20% of their free, operating cash they spend on capital expenditures. So they had 16 billion here and 20 billion here. So check that.
It's growing, that's nice.
15.5, 17.8, 18.6.
Free cash flow growth average over the past 5 years is 17.5, Paul.
So not free cash flow growth, free cash flow average.
My apologies.
I'm going to sit there and say you got to multiply this by 15 because it's a good brand, but it's slow growing. What's 17.5 times 15?
263.
And they're currently at 400.
400 billion.
So we need the stock to drop 25%. No, 30%, 35%. We need the stock to drop 35%.
Okay, so what we did is we have the free cash flow average over the past 5 years.
17.5.
We multiplied that, which is pillar number 8, our price to free cash flow. We usually want that less than 20. Paul did it times 15
Why is
because
that?
this is a slow growing company with not much of an exciting future, I would say, Paul. Would you say?
Correct. I doubt it's going to have much growth besides acquisitions. In fact, we can look at the acquisitions and see what they're doing. So look at this: 5.8 billion, almost a billion, $35 billion acquisition, 4.5 billion, 900. So they're making growth through acquisitions. I mean, it's fine. It's just it's more likely to dilute you because they might issue more shares. It's fine though. It just makes it a more established company. But I picked 15 for that reason. 17.5 times 15. And that equaled $260 billion. That's the value I put based on cash flow for the company.
260 billion?
Yes.
So
and it's currently at 400 billion.
They're just overpriced. They're too expensive.
So you need to drop by 35%. The company's currently selling for $152, 35% $50. So call it $100. I want this at $100.